If you think New Zealand property market is just cooling down, you're completely missing the big picture right now. Quite financial shift is happening behind closed doors that will completely change how Kiwis live and how migrants build a future here over in the next 5 years. While everyone is watching the headlines, the smart money is moving somewhere else entirely. Today we are breaking down the pros and the brutal cons of what actually means for your pocket. Let's look at the data. First, the property market. TradeMe just reported a substantial drop in an average asking prices, and dwelling values have completely flattened. But here is the real kicker. Fresh lending data shows a fewer Kiwis are taking out newer mortgages to buy a home instead of existing homeowners are mass migrating to mortgage top-ups. Let's analyze this. The pro for buyer. The power has completely shifted to you. If you are a Kiwi or a migrant with a capital, you can negotiate hard because asking prices are bleeding out. But here is the con and the future warning. People aren't buying new homes because they can't afford to, or they are locked out of it by high interest rates. Instead, homeowners are topping up their current loans just to survive, renovate, or consolidate debt. The impact for everyday Kiwis' wealth through housing equity is stalling. For migrants, this is a double-edged sword. Renting might get slightly more predictable as values flattened, but getting new bank approval to buy your first Kiwi home is becoming a hurdle. It's turning into a market of improving what you have rather than buying what you want. Now let's talk about the big bank and your money. The High Court just finalized $6.7 million fine for ESB over anti-money laundering breaches. Sounds massive, right? Wrong. In reality, it's a minor rounding error against their massive $1.3 billion profit. Just profit. Yeah, and that's just a profit. Meanwhile, Finance Minister Nicola Will is defending a ban on unfair card payment surcharges, promising relief for your daily spending. The pro here is the government is finally tackling those annoying 2% checkout fees that is draining your wallet. This is a genuine win for a daily cash flow. A heavy con is the banking system is largely untouchable. A $6 million fine to a $1 billion bank is like a parking ticket to a millionaire. It doesn't change systematic behavior. Look at Raymond Healthcare. They just locked in a massive $150 million bond at 5.72% interest rate to pay off the old debt. That was only costing them 2.55% of debt. Realistically, the economy is running on fumes. When truck traffic drops, it means a local business are moving, fewer goods consumers are buying less, and economic momentum is softening. We are experiencing a two-speed economy. Booming for export, stagnant on a main street, the impact for Kiwis in the regions, the export boom. Keep jobs secure. But for migrants and city dwellers, the local slowdown means business are tightening budgets, making job market highly competitive and sponsorships harder to secure in non-export industries. Finally, we have to talk about the future. Cost of living here. Big insurance IAG is begging for coordinated 15-year roadmap to effectively reduce New Zealand's natural hazard and climate risks. At the same time, investors are panic buying government bonds, flooding them with $2.36 billion in a bid for a $450 million offer. Global investors see the New Zealand government as a safe money that keeps our country stable. Cons, if we build infrastructure to mitigate climate hazards now, economists warn the future cost will compound exponentially. For Kiwi, your insurance premiums are going to keep climbing until infrastructure improves. For migrants looking to settle long term, choosing where you buy a home or start a business matters more than ever. You need to look at climate hazard maps before you look at the school zones. The data doesn't lie. New Zealand is pivoting from a property-fueled economy to an export and survival economy. Are you holding off on buying a home or are you topping up your mortgage? Let me know in the comments below.